to the Inspire Wealth podcast with Prof, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome to another episode of Inspire Wealth. I am your host, Mallory Meehan, aka Prof M, and today I'm joined by Mathew Simmons. Matt, welcome to the show.
Thank you for having me on. I'm excited to be here.
Absolutely. So one, I love your background, so it's awesome. Two, why don't you give us a little bit of background about you and kind of where you're at currently in your business and your investing career?
Sure. So, I've been in real estate for about 18 years now. I started investing in real estate back in 2006. I am currently the founder and CEO of a private equity group called SIMM Capital, which I founded and started technically in 2014. We are primarily a multifamily private equity firm. We did invest solely in larger multifamily apartment complexes, primarily across the Sun Belt, up until about 2020. Starting in 2020, we opened up a new fund that focused on affordable housing. So now we have both of those asset classes, multifamily and affordable housing. We own just shy of $420 million worth of real estate across 9 states currently.
Wow.
Just almost 4,200 doors total. We've done about $700 million in total transactions since 2014. We've gone full cycle on 2 funds. We have 2 funds that are currently open or currently operating, and we have 2 funds that are currently open that we're raising on right now. One being multifamily, one being affordable housing.
Awesome.
So yeah, I mean, I've been in business for myself for almost 20 years. I started in real estate back in 2006. I had sold a business with a partner and started just investing myself with my profits in the real estate. And this is where we're at today.
So it does pay off in the end, is what you're saying.
Yes,
I
it
love that.
does. I mean, I've been involved in a lot of businesses across a lot of sectors and a lot of industries. There's a reason why, the saying that, 90% of all millionaires have either made their money in real estate or have a large real estate portfolio now that they are millionaires, because in my opinion, the best investment you can make. And it's stood the test of time. Right. Yes, we've had corrections. Yes, we've had, peaks and valleys and stuff like that. But real estate always comes back. And it's one of those things that over the long haul, it's going to appreciate for you. It's not a get rich quick thing. It's a get rich for sure thing. And it takes time. But it is one of the tried and true methods of investing that can really build wealth.
100%. And that's exactly why I have this podcast. That's exactly why I bring people on like yourself. And I love that as a message.
Yep.
So you said you were originally investing in the Sun Belt. Can we get into maybe how you determine what states you invest in, or
Sure.
what the process looks like there?
Yeah, so really, I mean, there's a couple of things that we look for. Obviously, we want to see population growth. We want to see areas where, with our multifamily, I should say, we want to see areas where there's consistent population growth year over year. We got in before the big boom, like in 2020 and 2021, where you saw a lot of people leaving their home states and migrating to the Southeast, Florida, Georgia, Texas, stuff like that. During that time, prices just got so inflated. But even previous to that, there was a ton of migration growth. You had the boomers that were starting to retire and moving down into the Sun Belt area. And so for us, we really look for areas that have good population growth year over year, good real estate appreciation, consistent year over year, as well as rent growth year over year. The other major thing that we look for, and I don't want to go political, but it is a piece of how we identify where we're going to invest, is we do really try to stay out of blue states for the most part. Landlord laws in blue states, they're just not friendly to landlords in a lot of areas. They're much more tenant friendly. And so we do try to stay out of investing in blue states and heavy populated blue cities as well, because it can make it very tough as a landlord to operate if you have to, handle evictions or any sort of tenant issues whatsoever. So that is a big area that we focus on, or a big point that we focus on when we're looking at cities and states that we want to invest in.
So if you are looking at, let's say, 2025,
Mhm.
what states or maybe major metropolitan areas are you seeing as being like the place that you're most likely going to be putting your money in?
So we do still like the Southeast somewhat. We're staying out of Florida. We're not targeting anything in Florida right now,
Smart.
mainly because prices have gotten so elevated.
And
The
insurance.
problem well, that was the next thing I was getting to. Insurance is, if you can even get insurance
Right.
on a property right now, which a lot of people can't get insurance, it's just so overinflated price wise. We had an investor actually that sold one of her multifamily properties that she owned in Florida because she couldn't get insurance on it anymore. She owned it outright, but she couldn't get insurance on it anymore, and she wasn't going to take that risk with hurricanes, right, in
Oh,
Florida. So she sold it and dumped all of her money into our fund because she was sick and tired of having to deal with it.
yeah.
So we do stay out of Florida. So Georgia, we like Georgia a lot. There's actually we're in the process of taking down and closing on a 607 unit portfolio in Georgia. It's about a $45 million deal.
Nice.
We like North Carolina, we like South Carolina, but we also really like the Midwest now. We like
Yeah.
Tennessee, we like Oklahoma, we like North Texas as well. And those are areas that we're really focusing on growing into as well.
Cool. Is there a different process when you're looking at your multifamily investment versus your affordable housing
Yeah.
investment?
Yeah, absolutely. So most of our affordable housing is made up of primarily either single family homes or small, multifamily duplexes, triplexes, quadplexes, and some smaller multifamily complexes. We have a 24 unit complex in that portfolio. We're closing on a 48 unit complex for that portfolio as well, but we do focus on the smaller stuff. The markets that we look for that specific fund and that specific portfolio it's a complete 180 from our multifamily, because we got to look in areas that have high demand for affordable housing, right? Which in our affordable housing fund and portfolio, we focus on subsidized housing, right? Section 8 subsidized housing, as well as some other programs. So you have to look in markets that have a high demand and a high voucher count for voucher holders. And so a lot of those cities or a lot of those states do it kind of I'm a bit of a hypocrite, I could say, because it is in a blue state or blue cities,
Yeah.
but that's just where the demand is
Right.
for those properties and for that demographic. So it is a completely different underwriting process. We have to make sure that the properties that we buy are within a certain buy box where the rent that we can get based off of what the housing authority subsidizes makes sense.
Mhm.
And it's really hard because that buy box is fairly small. I mean, you're talking 100 grand to $125,000, right? 130 grand in some markets. Um, and that's really limited where you can buy houses for that price point anymore.
Yeah.
But with the housing authority and the way that they've increased rents in a lot of markets up until 2025, which I'll talk about in a minute too, there's still a handful of markets out there that worked. Coincidentally, the housing authority for 2025 has actually started reducing some of their fair market rents in some markets, and it's the first time I've ever seen them do that
Wow.
personally. And they've gone a lot more zip code based, right? So like Cleveland, Ohio is a big market for us with our affordable housing fund, right? Um, Up until 2025, it was all county based. They didn't break it down by zip codes. Well, starting in 2025, now the housing authority has started breaking most markets down by zip codes. Not all, but by zip codes. And in some zip codes that we have properties in, they've actually dropped their fair market rents by 6 to 7%,
Wow.
which is really odd. But I think what's happening is because, for the last 3 or 4 years, we saw, a 10%, 11%, 12% year over year fair market rent growth
Mhm.
due to inflation and keep up with inflation. I think now they're starting to say, okay, well, inflation's starting to tame itself a little bit, not a lot, but a little bit, or enough that they say, okay, we can now drop rates in some of these zip codes and we're going to raise them in other zip codes, but we're dropping them in some of these zip codes because we're overpaying for what the market rate rents are in this market. So it is making it a lot more difficult for us as a fund operator focusing on that. And honestly, I feel like it's going to hurt more than anyone, it's going to hurt the tenant base, the people that need homes, that have vouchers, but there aren't enough homes out there as it is for those voucher holders. This is only going to hurt them even more. And so it's like, I kind of feel like the housing authority is working against their own tenants in a way in this instance, because it makes it harder for us to be able to buy more houses, or it doesn't make as much sense in some places for us to buy more houses to put into the program because of the way that they're now doing things.
Right. So you said Cleveland, Ohio is one of those kind of major markets for affordable
Yep.
housing. Is there another market that kind of stands out? And are you seeing any other kind of like challenges within the affordable housing realm?
There's always challenges in the affordable housing realm. We're in a couple other markets. We're in Mobile, Alabama. We're in Birmingham, Alabama. We were in Detroit. We also were in Memphis. We actually pulled out of both of those markets. We liquidated our holdings in both of those markets, mainly because for a couple reasons. Crime in both of those markets is extremely high. The housing authorities in both of those markets are extremely difficult to deal with. Then you take into account, this is more for Detroit versus Memphis, but Detroit's underlying infrastructure is so old and dated that there was a lot of infrastructure issues in Detroit with, sewer lines, water lines. It's all old, it's all dated, honestly, it needs to be completely replaced pretty much citywide. But it presents a huge challenge because those are big ticket items. You're talking about 9 to 10 grand to replace a sewer line, on a property that you paid 100 grand for, right? It's 10% of the value of the property.
Right.
So it didn't make a whole lot of sense. And unfortunately, there's a huge demand there for Section 8 and from voucher holders. But from an investor standpoint, because yes, we're trying to help those out that need housing, but it has to make sense from a dollars and cents standpoint. It just didn't make sense for us. So we actually sold our portfolio there, sold everything in Memphis as well, due to primarily crime and the housing authorities. So just really difficult to deal with. And we're focusing on those three major markets now.
Got it. No, that's awesome. So if somebody were to think that they want to get into affordable housing, and uh, I understand, I have a lot of students who tell me that they're like, I really want to get into like the Section 8 game, and I want to, have guaranteed rents. What kind of lessons or what kind of advice would you give to people who are maybe thinking about starting out investing in that particular niche?
Don't do it. If I'm being 100% honest. And it's not that I'm not saying it's not a good asset class to invest in, but there's so many more moving parts when it comes to not only single family investing, but then you add in any sort of government subsidized housing. There's so many more moving parts to it. Um, you know, it drives me insane because you see all these I'm going to say gurus in quotes, right, on social media that push these Section 8 courses. Oh, it's so easy. It's guaranteed rent. It's this, it's that. All you have to do is this. I can guarantee a nine out of 10 of those people on there don't actually own any Section 8 or affordable housing real estate.
Right.
And I say that because a lot of what they say is a blatant lie. They're talking about, oh, you only have to put 10 or 15% down. And then they show a screenshot of the fair market rent from the HUD website. And like, this is what you're going to get. And this, I'm like, well, first of all, the lenders that they're talking about online don't do an 85% loan to value loan on any property.
Right.
And the minimum loan amount now with a lot of those lenders these people are talking about on social media is $100,000, right? But they're talking about getting a loan for $60,000, right? So that there tells me that they don't even know what they're talking about because they haven't actually done it. But it's just, there's so many more moving parts, right? Because you have the housing authority you have to deal with, you have the inspections you have to deal with. If you're buying single family homes, every single family home you buy, it has its own roof, it has its own furnace, it has its own air conditioning condenser, it has its own plumbing line, its own water supply line. Like, there's just so many more moving parts that as a first-time investor, it can be extremely overwhelming. And then you're dealing with the government, organizations on top of that. You have to deal with the housing authority. You have to deal with the inspections. And there's so many hoops that you have to jump through with them as well. And on top of it, it takes a lot longer for the most part to get cash flowing because you're dealing with government organizations, and it just takes forever to get things done. In Cleveland, for example, we were averaging cash flowing about 30 days. Now it's 90 days
Oh my
between
gosh.
the time it takes them to process a tenant application, get back to you with their rent offer, which, by the way, what the HUD website shows isn't what you're guaranteed to get. That's the most you can possibly get.
Right. Right.
There's other factors that they take into play: affordability for the tenant, market rate rents. Are you in line with market rate rents? Are you paying utilities, or the tenant paying utilities? Those are all factors that people don't understand. They think, oh, fair market rent number is 1450. That's what I'm going to get. No, nope, you're not. But and then by the time you get the inspection done, or the inspection scheduled and then done, and let's say that you pass on the first try, which most of the time you won't because they're going to nitpick you, you're 90 days before you're actually cash flowing now with a lot of these housing authorities because they're so understaffed and they're so overwhelmed. And so there's just, if you're going to go into it, just understand that it's not as easy as everyone makes it out to be. And there's a lot more moving parts, and it's going to take you time to cash flow. And that's why I tell people if you're just starting to invest in real estate, do not go affordable housing. Do not go Section 8 or subsidized housing, because you need to learn the ins and outs of real estate before you go that route.
I agree. I couldn't agree more. I mean, I don't own any Section 8 housing. I've, obviously read about it and I
Yeah.
understand the legal side of it. But that wasn't an animal that I ever wanted to kind of come close, because I've bought and I've sold a lot of properties to people with FHA loans and VA loans.
Yeah.
And so I know
Uh-huh.
the inspection process with being a government loan. So I can
And
only
it's even worse.
yeah,
Yeah.
can
It's
only
even worse.
imagine
Yep.
the government's paying out monthly and they want to
Yep.
make sure that their asset is,
Yep.
protected.
Yep. And
Um,
yes, guaranteed rents is a good thing, but most of the time the tenant still has a portion they have to pay, and you're always going to be chasing that tenant for that portion, no matter what, for the most part. Now, we I made the mistake actually back in 2006 in investing in affordable housing first. So I cut my teeth in real estate in this asset class. So I learned a long time ago, which is the only reason why I started the fund and built this portfolio, is because I knew the ins and outs of it. And even for us, it's challenging. And we own our property management firm, right? We have people that specialize in that stuff. But even then, it's a challenge, right? And you can underwrite your tenants the best you possibly can. You can make sure they have decent credit. You can get a full security deposit. You can get full first and last month's rent, for their portion from them, but you're still going to be chasing them for their portion of the rent. And even if it's $50 over 6 months adds up,
yeah,
right?
absolutely.
And the problem is, in a lot of these areas that, like I was talking about earlier, that are not landlord friendly, Cleveland takes over a year to evict someone. And so it doesn't, you're going to spend thousands to even go through that process on someone that might owe you $600 or $800 in the grand scheme of things. And so, okay, does it make sense to go the eviction process? Do you try to get them to pay you? Do you do cash for keys to try to get them out? I mean, there's just so many more moving parts in this asset class.
Yeah. Well, I'm curious to know, like, when you have tenants that are either being evicted, because I've been through the eviction process, I understand
Sure.
the challenges with
Yeah.
that. But do you find that those living in Section 8 or affordable housing treat the property different than you would see from your traditional multifamily tenants?
Yes and no. I'm gonna So we do try to eliminate that aspect the best that we can, by making tenants pay a full month's rent, security deposit, making them pay their portion of first and last month's rent. When you do that and they have, $1,400 or $1,500 or $1,600 or whatever it ends up being on the line of their own money, they do tend to take care of that property better than a lot of other Section 8 tenants. The problem with a lot of Section 8 operators is they don't understand what you can and can't do, in the program, right? And that's why I see, like, when we're looking at buying properties for this portfolio, we see other operators, they don't have any security deposit from their tenant. And a lot of times they don't even realize they can collect a security deposit because they're in low income housing, right? Well, that's your protection, right? And so when we find that out, a lot of times when we actually get into the property's trash. Well, of course it's going to be trash. The tenant doesn't care. They're none of their money's on the
They have
line. They're just
nothing
going to move to the next house, and it'll be in new condition or better condition for them, and they're going to trash that one too if they don't have to put a security deposit down.
on.
So we really do try to at least make the tenants feel like their money's on the line by collecting that money up front, and it does help. Now, you're still going to have tenants that are going to beat the property up no matter what. They just don't care. And we'll keep the security deposit, and if there's more damage, typically we'll just write that off, because going after them and getting us, in small claims court to try to get some of that money back, what are you going after? They don't have anything anyways.
Right.
So you do have to be careful in this asset class with tenants. We do try to head that off the best that we can, by collecting those security deposits, collecting the first and last month's rent. But I've also seen tenants in some of our, class B plus properties that, you would think would take care of their units really, really well, that have just completely trashed them. So I think you see that in real estate across the board.
Yeah.
Yes, I think it's more prevalent in low income housing, and affordable housing. But I also think there's ways to mitigate that risk the best that you can too.
Yeah. I mean, it's hard, you can do as much tenant screening, you can do, all of those things, but at the end of the day, you can never actually know.
No, you can't. I mean, the other thing that we do too is with that portfolio specifically, we do quarterly spot inspections with
Oh, that's
every
a good
unit
idea.
that we have.
Hmm.
And they get 24 hours notice. And part of our lease is, with 24 hours notice, we can enter your property at any time, whether you're home or not, to do those spot inspections. That really does help us crack down on, if someone is damaging the property, we catch it early on, and they get the opportunity to either fix it or they're out.
Hmm.
And so it does cut down on the large ticket items being damaged. But then again, I mean, we catch people with multiple dogs all the time, multiple animals, even though they're not supposed to. But that's where those quarterly inspections really do help.
No, that's a good point. Okay, let's change into your multifamily.
Sure.
So, is there a specific asset class type that you generally look for? Are you doing any kind of new builds? Are you looking for value add? Or tell me a little bit about that strategy for that fund.
Yeah, so our business model is strictly value add. We don't do any new development. Development costs, especially right now, with material costs, labor costs, land development costs, are just so astronomical that the numbers just don't work out. And with our business model and our hold time, we don't like holding things for 10 years. And so it's really hard to make the numbers work with new development. So our kind of bread and butter is that, class C plus, class B value add, 1980s, 1990s vintage build that, is that garden style type of property that, we can come in and, we can update the units. We can, put in, LVT flooring. We can put in, new cabinets, new countertops, freshen things up, increase curb appeal on the property as a whole. Raise the value, get rents up to market average, stabilize it, and then kind of manage it, and then flip it to the next owner. That's what we're really good at, and that's what we've done, since I started in multifamily. And it's just what we know. We like being able to force appreciate that property. We know we can raise the value of that property quickly, and then we can cash flow on it, and everyone's making out. So that's kind of our, that has been our bread and butter and our focus, and that's going to continue to be our focus moving forward. We have some opportunities to do some Class A stuff with some potential, joint venture partnerships that we're looking into, but we haven't done anything yet. With that does come some new development, but again, the numbers have to pencil out, and we haven't been able to make them pencil out up to this point.
Yeah. Have you been looking into any mixed use multifamily, or has it strictly been multifamily?
It's strictly multifamily. There's been some opportunities where we've looked at some mixed use stuff. We've never actually taken anything down and own anything that's mixed use. And especially since COVID, we really stay away from really looking at anything mixed use, because office space, retail has really suffered, and vacancy is way up in those types of properties. And so for us, it's just we don't do commercial, in the sense of that type of commercial. And it's just for us, it's not appealing. Let's put it that way.
Yeah, no, totally. So for your fund, how do you typically look at financing the property? Like, are you raising 100% equity? Are you, putting out debt? What kind of a
Yep.
structure are you guys generally doing?
So 99% of the time, we are typically raising about 20 to 30% equity, maybe a little bit more for each property. We'll take debt. We'll take it down the rest with debt. And it depends on, what condition the property is in, what the occupancy is, what stage it's in, whether or not we're going to use agency debt or whether we're going to go bridge or mezzanine debt. Most of the time, because of its value add, properties are not meeting agency debt requirements, the 90% occupied for 90 days. And so we'll typically take something down with bridge debt, or we'll use creative financing. We love creative financing. We've been really heavily focused on seller financing over the last couple of years, and it's worked really, really well for us. But yeah, typically that's kind of how we'll take down a property. We'll raise between 25 to 35% in equity from outside investors. We'll take the rest down with debt or creative financing. Once we've been able to get into that property, get the property renovated, get the units turned, get it stabilized and rented up, then we'll typically flip it out into long-term debt with agency debt at that point and just kind of manage it for, between 3 and 5 years.
Okay, so it's a shorter hold period.
It
Um,
is.
are you doing like 1031s when you dispo, or what's your exit strategy looking like?
So most of the time we're not 1031 exchanging. A lot of times our investors want their funds back, and then they'll reinvest at that point. And the way to I'm not a big fan of 1031s. I'll be 100% honest.
Okay.
They are extremely difficult to structure from a fund standpoint.
Hmm.
You either have to go Delaware statutory trust,
Hmm.
which it's just no thank you, because then we have to involve broker dealers to abide by SEC regulations and law. And if we do it as a tenant in common, then every single investor
Has
is
to
going to
be
have to be on the
right.
debt and on title, and then they feel like they have a voice in how the property is managed. And then you get into the situation of you have too many cooks in the kitchen.
Yeah.
And I'm the type of person where, yeah, I like kicking my tax can down the road, but we can do that through depreciation.
Yeah.
Enough to the point where I try to stay away from doing any sort of 1031s at all.
Yeah,
Um,
I could see how having a fund that would be really, really challenging to,
it
yeah,
is.
get
Yeah.
everybody on board.
And we lose, we also lose some investors, because we typically will turn away 1031s. We have investors that say, "Hey, I need a 1031 into something," and we'll be, guys, we're not the fit for you. We're not the ones for you. There's other funds out there that will jump through all those hoops. We're not one of those,
Yeah.
and that's okay.
Yeah.
We don't take every dollar that people want to give us. So we try to stay away from those 1031s for sure.
Do you what is your minimum buy-in for your fund, and how's the fund structured?
So it depends. So our affordable housing fund, it's a GPLP type of partnership. Every single investor set up as an LP. That's a minimum 50,000 investment. Our average investor in that fund is probably around 200,000. To be honest, we've raised on that fund. We started off. It was a five. We were testing the waters because we weren't sure what people's appetite was going to be with affordable housing.
Sure.
And we weren't sure if institutional capital was going to have an appetite for it or not. And so we put a teaser out there of a $5 million raise initially, and we had that filled in 3 months.
Wow.
Yeah, so we go, oh, we might be onto something here. So we bumped it to a $10 million raise, and we got really close to that a couple months after we did that, and we go, okay, we got to bump this way up. So we actually bumped it up to a $25 million raise. We're about we've had it open for about a year and a half now. We're sitting right about 18 or 19 million so far that we've raised on that. We're probably going to take it from 25 to 50, to be honest.
Wow.
And it's
Okay.
going to be a $50 million fund with affordable housing. That $50 million fund is going to buy us, well, let's see, the 25 million was targeting about 1,000 doors in that. So if we do 50 million, it'd be about 2,000 doors at about, an average about 105 to $108,000 per property. So you can do the math on what the
Yeah.
overall value will be there. Um, our multifamily is set up a little bit different. It's still a GPLP type of structure. Um, it's $100,000 minimum buy-in on multifamily. We do have more institutional partners though in our multifamily space because institutional capital has more of an appetite and they're more experienced and they have experience with multifamily, so they understand it better.
Right.
So we have family offices that have invested. We have smaller pension funds, stuff like that. But we do have a lot of just individual high net worth investors as well. I would say our average investor in that fund's probably closer to 500,000 um, overall, and that's $100 million fund. Every multifamily fund we do is $100 million. Now, we typically do take down in the properties on an individual basis, and people will use the word syndicate. That's the new term that's been thrown around a lot in the last 3 to 4 years. It's just private equity. It's no
Yeah.
different than they've done it for 100 years. But
Yeah.
that's the term that people understand now. I just hate using that term personally. But what we have found from an investor standpoint in that specific asset class, investors like to be able to choose which property their money is going into, whether it's a high net worth investor or whether it's an institutional partner. They
Mhm.
like to be able to say, yeah, I want my money going in this property, but not that one. And if we do it on a fund basis, it's at our discretion. And a lot of investors don't like that. You
Yeah.
do have some that prefer that, but most like to be able to pick and choose which property that their money is going to go into.
Yeah. So I'm curious how you go about identifying these properties and how you come up with your lead source, and
Yep.
give me some background on how that has happened and maybe strategies that you plan on using in 2025.
So we try to buy, well, I've built really good relationships over the last, 18 years basically in real estate. And especially since 2014, since starting the firm itself. So a lot of our leads come via off market. They're coming direct from brokers that have, properties that they're gonna take to market if they can't get it moved, off market. So we do try to buy things off market. We don't want to get into a battle with another buyer with an on market property. We also have other investors, other fund, founders or owners that have taken their property as far as they want to take it, and they'll come to us and say, "Hey, Matt, we're looking to offload this property. Are you interested in it?" In fact, that's where the Georgia portfolio, the 607 unit, $45 million deals came from. Is from another operator that he was like, "Look, we want to focus on other stuff. We don't have the appetite to see these four properties through to stabilization. Is this something you're interested in?" And so most of our stuff comes, or most of our leads come via that method. We'll still scour the on market properties, but there's a reason they're on market most of the time, and that reason is that they're asking way too much,
Yeah.
which is why they're sitting on market and haven't been scooped up yet.
Yeah.
Um, so, that's typically where our leads are coming from. That's typically how we're identifying properties. We do some prospecting, with owners directly, via some of the data, technology that we have access to. But we're not doing a lot of that because our lead sources via the brokers and other operators is enough to fill our pipeline up consistently
Mhm.
that it works better. And there's a lot of with that cold prospecting, there's just a lot of effort you have to put into it for very little return.
Yeah, totally. So you mentioned that you have your own property management company.
Yep.
So you're almost entirely vertically integrated. Do you have your own contracting company, or how do
Yep.
you handle like maintenance and repairs?
Yeah, so it depends. We do own our own property management company. That property management firm is primarily focused more towards the affordable housing fund right now. Um, but we are working on bringing everything, including our multifamily holdings, into that firm. It's just there's so many doors there that we can't overwhelm the property management firm with all of them at once. I do prefer to be vertically oriented or integrated, which is why we have our own property management firm. We do have our own maintenance company as well. We do have people on staff for that in the locations that we have our portfolio. Um, we will utilize outside vendors as we need them as well, obviously. But it allows us to control being vertically oriented like that, having our own firm, having our own maintenance company allows us to control costs a lot better. And in that, especially affordable housing, but multifamily too, cost control is huge
Mhm.
because your costs can get out of control really, really fast in real estate if you're not paying attention to it. Because everyone and their mother will submit a ticket. If they've clogged their toilet and it's their own fault, they're going to send in an emergency ticket for the clogged toilet. And it's like, guys, get a plunger. Like,
Right. Right.
it's not rocket science here.
Yeah.
You know what I mean? But
Yeah.
but that's that asset class, and that even in multifamily, you have that silliness as well. But yeah, we like to. I structured things to be very vertically oriented to help us control costs a lot better. Everything's run locally from here, from our corporate headquarters. And then we have on the on the ground boots, in the locations that we have properties.
I'm sorry, where's your corporate headquarters?
We're in Pittsburgh, Pennsylvania.
Oh, okay. Wait, what part of Pittsburgh?
Wexford,
Okay, I was just there for Thanksgiving.
where are you?
Yeah.
Yeah,
That's
you're from the area,
I
right?
am. Yeah,
Yeah.
I'm from Elwood City, which is
Yep.
a little bit more north. But my cousin lives in Wexford, so that's where we spent Thanksgiving.
Yep.
I
Yeah,
love
we're in
that.
Wexford. We have a regional office in Fort Lauderdale, Florida as well.
Okay.
A lot of the only thing done down there, however, is fundraising. So I have investor relations individuals that are based there that really focus on the much higher net worth individual, the $1 million plus investor, as well as our institutional capital. So that's all they do down there.
Yeah. So are you investing in the Pittsburgh market?
We do not.
Interesting.
Yeah.
Okay.
Well, we haven't to date, I should say. We are starting to acquire properties just now. We have, I don't know, a dozen or so under contract, I think, right now for the Affordable Housing Fund
Yeah.
portfolio. But up until this year, Pittsburgh was I didn't like Pittsburgh as a market to invest in for affordable housing, mainly because the housing authorities did not pay enough. Their fair market rents weren't high enough for
Mhm.
what properties cost here. Pittsburgh has always been a fairly stable real estate market. We didn't see the huge peaks and we didn't see the huge valleys during the big bust in 2008, 2009, 2010. However, property has, statistically been appreciating 3.5% year over year very steadily in this market.
Mhm.
And price points have just gotten kind of not out of whack, but they've gotten to the point where from a subsidized standpoint, the rents don't, you can't cash flow in most markets here in Pittsburgh. This year for 2025, I should say, um, the housing authority bumped rents fairly significantly, where in some markets you can make numbers work. And so those are the markets that we're focusing on in Pittsburgh moving forward to add some to that portfolio. As far as multifamily goes, there's nothing here that really fits our business model. You have stuff that's really old, 1960s, 1970s,
Mhm.
or you have brand new stuff.
Right.
And neither one of those fit our business model from the multifamily side. So we don't invest here.
Interesting. Okay. Have you explored student housing?
We have, and every time I go run in the opposite direction as fast as I possibly can.
I want to know why. I'm curious. Obviously, I live in a college town, so I'm
Right.
always interested in multifamily. I'm like, oh, your student housing. Like, what's your thought on that?
Um, well, let's just put it this way. I know how I was at that age. And I don't really want to willingly put those types of tenants into a property that I own.
Fair,
Now, I
fair.
mean, there's ways to mitigate that risk, making their parents co-sign stuff like that. But you also have higher turnover as
Yeah.
well with student housing, and we don't we have high turnover Well, it's another reason why we don't do short-term rentals is because you have a lot more, your turnover is a lot more, right? And with higher turnover comes higher expenses.
Yep.
And so for those reasons, we've explored it. We've underwritten some student housing projects and properties. It's just we've never pulled the trigger, and it's not really something I can't say we won't do, but the numbers really have to be really, really good for it to make sense.
Got it. Okay. So if I find a student housing deal, you might not be my guy.
I'll take a look at it.
Okay.
I mean, it's a dollars and cents type of thing,
Yeah.
right? If the numbers
Totally.
make sense, okay.
Yeah. Okay. So
But
I
I'm
like
not actively out there prospecting student housing.
makes sense. Makes total sense. Listen, I have a fraternity in my backyard, so like
Right.
I get
Yeah.
it. I get
I don't want that.
it. I always like to ask my guests, especially those that are actively investing in, a lot of different types of assets. What is one of your pinnacle stories that you will never forget? That's like one of those stories that you always tell maybe new investors or, some lesson that you learned and it just stands out as being like, I would never do this because this is what happened.
Oh, I don't know if I have a story like that. But I always tell people because anytime we talk with a new investor, they're like, tell us about your biggest deal that you lost money on or something like that, right?
Mm.
And I can honestly say we have never lost money on a deal that we have done in our multifamily fund. We've lost some money on some of our properties in affordable housing, but that's just because of the asset class that they are. And you're talking about 100, $110,000 properties.
Sure.
And like some of the properties that we liquidated in our Detroit market and our Memphis market, after we paid commissions and stuff like that, we probably lost a little bit. But I love being able to tell people the only money I've ever lost in real estate is actually on my own personal homes that I've bought over the last 20 years, which, believe it or not, is absolutely true. I've lost money on three of the four personal homes I and my now ex-wife purchased over the last 20 years. And I did that, and it happened because she was so emotionally attached to them that she made me buy them, even though I knew it wasn't a good investment. So that leads me to what I tell a lot of people is that I don't personally believe your own home, your personal home, your primary residence is an investment
Yeah. It's
because it's
not.
not.
It's not.
I don't personally feel it is because my personal experience. And everyone's like, "Oh, no, it's an investment, it's an asset." I'm like, "Well, is it paying you every single month?" No, you're paying for it every single month, right? You're not making money off it. Yeah, you need a roof over your head and there's nothing wrong with buying your own home, but it's not an investment.
Yeah. Yeah.
Is the way I look at it. So, I know that's probably not the type of story you were looking for,
No,
but
I
it's
mean,
it's something that I tell people,
yeah.
every new investor that I talk with, because typically we always get asked that question. And I could honestly say I've never lost investor money on any of our deals. Only time I've lost money is when I've bought my own personal home.
Well, and I always tell people you always have to take emotion out of real estate. Like
Yeah.
I think that's one of the hardest things, especially if people they have a home, they're moving, they decide to keep the home as a rental. And
Yep.
then, they become so emotionally attached to that house that every little thing that happens, you
Yep.
know, it just kind of spirals
Yep. Yeah. Or if their tenant says they don't like this or they don't like that or whatever, they take that personally
personally.
because it was their own home
It
that
was
they
their own
lived in.
home.
It's like,
They
well, you don't live
chose
there
it,
anymore.
they put
Right.
it in. Yeah.
Yeah, move on to
Yeah.
the next. But yeah, I mean, real estate. It's for a lot of people, it's an emotional purchase. A lot of times, it's the biggest purchase they're ever going to make.
Yep.
I even see investors getting emotionally attached to properties, and I'm like, a piece of real estate is the last thing, except for the house that I'm building for me and my kids right now, which is my dream home, and it's the last time I will never get personally attached to a property
Yeah.
because it's a numbers and it's a dollars and cents thing for me, right? It's a numbers game, and that's how I look at it. If it can make me money, great. If it can't, okay, I'm not buying it.
Yeah. Totally. Okay, so a lot of people listening are new investors or people thinking about getting into the real estate game. What beyond not being emotional about real estate and, making sure that you're figuring things out before entering in. What kind of advice would you give new investors before they pull the trigger to buy their first property?
Um, Couple things. One, you have this generation right now and the times that we live in, you have so much information at your fingertips just by hopping on the online and searching on Google, and it's free, right? Make sure that you are constantly educating yourself on this industry, on the ins and outs of it, the different types of assets classes that there are out there, the different types of strategies that there are out there. Um, do not, I personally believe this, do not go below, 5 grand, 10 grand, 15 grand on a course or a mentorship program or anything like that, because everything that's in any of those you can find online for free. Go to Bigger Pockets, sign up for an account, go to YouTube, start watching videos. You're going to learn so much through those simple things that you don't need to go spend all this money on a coaching course or a mentorship where most of the time you're just going to be constantly upsold into something, but them trying to get more money out of you. And it's so prevalent right now and it's so all over social media. It's really easy to get wrapped up in those. The problem is most people that are buying those, that's all they will ever do. They will just keep buying these courses over and over and over again with different people, and they will never take any action. The second thing is that action always speaks louder than words, right? You have to take action if you want to be successful, right?
Mhm.
You can want to do something until you're blue in the face. You can say that you're going to do something, for 10 years, but in 10 years, you're going to be sitting there and not taking any action still. A lot of people in real estate who are just starting to get involved in it get paralyzed by over analyzing everything, right? Analysis paralysis, right? Is what we call
Yep.
it. You will learn for the rest of your life in this industry. And as long as I've been doing it, I still get surprises every single day. I'm like, huh, that's a new one. And it's like, wish I could say I'm surprised, but it's this industry. You
Yeah.
will always, be surprised with things in this industry. So just keep on learning. Um, the next thing I can say is that start investing in real estate before you buy your own home for yourself.
I like,
Or
yeah.
better yet, do it at the same time. It's called house hacking. And if you haven't heard of house hacking, especially with the new FHA guidelines now that you can buy multifamily and house hack, it's a great way to start investing in real estate and actually have your own home paid for you. And then you're able to scale it after that.
Yep.
I'm a firm believer that you should start investing in real estate as young as you possibly can before you buy your own home, because it's going to open up so many more avenues for you and it's going to build you a life that you could never imagine much quicker than if you actually go buy your own home and then you start trying to invest in real estate after that.
Mhm. Absolutely. So beyond searching on Google and YouTube, do you have any maybe book recommendations that you find to be some of your favorites, or are you like, nah, skip the books, let's just go online?
Um, I don't have the attention span to read a lot. I'll be 100% honest. I don't know whether I have ADHD or not, but I'm constantly like 30 million things going at a time.
I,
For me to sit
I'm the
down,
same way. I'm
I
the
get
same.
so bored so easily. Within 5 minutes, I'm like, yeah, I'm done with this.
I
Um,
have so many bookmarks in my books after like a couple
right,
chapters, and then I'm
right,
like, I
right.
haven't been back.
I mean, Think and Grow Rich is kind of like a staple, right?
Yeah.
Anyone that's ever been in real estate has either read that or knows that they have to read that. So that's definitely one.
Mhm.
Um, Robert Kiyosaki's book is kind of a staple.
I love the Rich Dad Poor Dad series.
Yeah, Rich Dad Poor Dad is really good. And those are kind of the two that I read very early on that I'll every once in a while I'll go back and just like pull snippets out of and read again or whatever, because it really does build good foundations for people or for you if you want to get into real estate.
Yeah.
And it helps shift your mindset on, money and investing and wealth and, you know, because I think, and I hate to say it because I know you're in higher ed, but I think higher education a lot of times programs people to kind of stay in that rat race mentality.
Mhm.
And it's very easy for people, I see it every day, to fall back into, that mindset of, trading time for dollars.
Yeah.
And those books help get you out of that mindset of thinking that way, and where you get to the point of understanding how to get your money working for you so that you're not constantly trading, your time for dollars, right?
Yeah.
It's
Absolutely.
the three different income, three different types of incomes, right? And you want to get to that point where you have that passive income coming in, that whether or not you have an active income or not, it doesn't matter anymore.
Right. Well,
And those books kind of build that foundation.
I'll tell you that the way that I teach my students is I teach them to think like an investor.
Mhm.
And so I always want to empower them, and house hacking is something I tell them, like, if I could roll back the clocks of time and I could do it all over again, like
You and me
I
both.
I
Yep.
would not have been renting for the 8 years I was in college. Like I would have bought
Yep.
something and I had roommates or, whatever that looks like. But,
Yep.
hindsight's 2020. All we can do is
Always.
hope and educate the youth, and hopefully
Right.
they don't make the same maybe missteps that we made. I don't want to call them
Right.
mistakes. But I think that, you know, getting involved early is like the key.
Yeah.
And
100%.
while I agree with you that, investing in a lot of education and mentorship is not necessarily the avenue to go, I do believe that some form of mentorship, finding somebody who you can maybe work alongside and like gain experience and show them what can I do for you, and all you want in return is just their time and their knowledge.
Yep.
That is, I think, a game changer.
100% agree. Yeah. I'm not saying mentors are not extremely valuable. They are. I had one. But I didn't go online and sign up for a mentorship and pay someone that says that they're doing this or doing that
Yeah.
or whatever, that you don't really have any track record with,
Yeah.
right? My mentor was someone that was local to me, that had experience, that I was able to bring value to him. And in turn, he was willing to give me his time, and, well, not really his time, but more his experience and his expertise. And over time I learned from him, right?
Yeah.
And so absolutely find a mentor. But when you find that mentor, don't call him up and ask him or her, hey, can I buy you a cup of coffee? I want to pick your brain, right? I hate when people do that. I'm like,
I
I
get
can
it
buy
all
my
the time.
guys, I can buy my own cup of coffee. I don't need you to buy me a cup of coffee. And unfortunately, my time is more valuable than that.
A cup of
And so
coffee.
come come to me with value. If you can bring value to me, and I don't care what that is, bring me a deal. If you want to come work, prospect for an hour at the office for me, whatever it is, bring me value. I will absolutely give you time and teach you along the way. Not a problem at all. But if you approach me with saying, hey, can I buy you a cup of coffee? I want to pick your brain. Or can I buy you lunch? I want to pick your brain. Or the best ones yet is, tell me how I can provide you value, and in turn, you can mentor me. Why am I going to do your job for you?
Yeah. You tell me what you're bringing to the table first, and then we'll.
Right. Yeah, like you do the research to know what it is I do and what I need. You
Mhm.
come to me with an offer, and I'll tell you whether or not it's what I need. In return, I'm going to give you guidance and education and mentorship.
Yeah.
But I think a lot of that stems from the I don't know if entitlement, but that instant gratification that society has nowadays. They
Mhm.
just they expect it almost, and it's like, no, you got to work for it. I had to work my ass off for it.
Yeah.
And my mentor wasn't the first one that I approached, and he wasn't very easy on me either. But it was invaluable what I learned from him, and when I learned what he needed, which took time, the value I was able to bring him was invaluable to him, to the point that that mentorship. Unfortunately, he passed away in 2010, but it was 12 years, that I was learning stuff from him,
Hmm.
and
So
that's stuff I couldn't have gotten if I paid for it online.
like, let's say those that are interested in getting into real estate, like, and when you say, tell me the kind of value that you bring, how should they be figuring out what value they bring, or like, even where to start with that? Like, what would you suggest?
Well, it takes time. I mean, you have to educate yourself on what that person is doing.
Mm.
For I don't care who you are, but you need to see, okay, what What's their experience? How long have they been doing it? What asset classes are they investing in? What's their date? What's their routine at? Where is their office at? Am I local to them? Am I across the country from them? What's their role in the company that they work in? Because I maybe it's not me that would be the mentor, but maybe it's one of my acquisitions guys, right? Maybe my acquisition person is someone that could mentor a person, right? Okay, well, what's their day to day? How, what technology are they using? And that takes interaction, and that takes asking questions, which there's nothing wrong with that at all. That's how you learn, right? Ask questions. But you really have to learn what that individual is doing and what business they're in, what asset class they're in, because if you learn all that, then you can learn what it is that they do in their role, and by being able to help them make their role easier, right? So for me, for instance, if you can bring me a deal that I don't have to go out there and prospect for, if you can underwrite a deal that you can come to me and say, hey, Matt, this is the good price based on this cap rate, this occupancy, this is the NOI, this is the future value, whatever it is, that I don't have to sit down and do that for 30 or 45 minutes. Perfect. That's bringing me value, right? Or if you bring me an off-market deal that maybe a buddy of yours that knows a broker, found out that they have, and you bring that to me and say, hey, Matt, I don't know if the numbers work, but this was brought to me and I know this is your asset class that you buy. I thought maybe you should take a look at it. That's bringing me value, right? You bring me an investor. You say, hey, Matt, I know, I'm really close. Our family's really close with this individual. I know they're high net worth people. They're looking to, place some of their money into a good investment. They might be worth talking to. That's bringing me value, right? Any way you can bring someone value, they're going to be much more, willing to give their time and their effort and their energy, which ultimately is money, because time is money, right?
Yeah.
But that takes time on someone's part to research, right?
Yeah.
So don't just come to someone and say, hey, can I buy you a cup of coffee to pick your brain? Because you're showing that you're not even willing to do the research and put the effort in to learn what that person is doing and how you can bring value to them. And so
Totally.
if you're not willing to take the time to do that, why is someone going to put their time and effort into giving you their time to teach you or mentor you?
Absolutely. Well, Matt, this was fantastic. I love talking to a local guy. I say local, that's my home,
Yep.
It was so great talking to you, and I appreciate your time. While I didn't buy you a cup of coffee, I certainly
Well, this is valuable for me,
yeah,
right? You
yeah,
bring me value and I bring you value, right? So it's
yeah,
a win-win for both
absolutely.
parties.
Love that. Okay. Well, that's a wrap for this
Perfect.
episode of Inspire Wealth. Again, thanks, Matt, for being on, and we will catch you next time. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.